All right, good morning, everyone. I know there's people still trickling in, but we get started right at 11 for our 20-minute Tuesdays. My name is Trent Zimmermann, and I'm the Director of Annuities here at BGA Insurance. Uh, I have a bachelor's in political economics, a master's in estate planning and finance. I have my chartered financial consultancy certification, and I am also a chartered life underwriter. BGA has been a top GA for the last 20 years, focusing on life annuities, long-term care, and disability. And this is your 20 minutes. Today, we're talking about the dark side of bonus products. Forgive the clickbait title, but there's a lot going on with these products that I make sure advisors know beforehand and before stepping in. Um, I have removed all names of carriers on this because as a GA, we are carrier neutral. We sell over 65 different carriers. And there are time and place for different strategies, different carriers, different products. I don't want to be disparaging of something publicly and then the next day find out from me that that product actually works well for a different kind of strategy we're talking about. I am happy to be fully transparent and honest over the phone, and we will have other discussions here where we might highlight a carrier. But for today's case, everything will be redacted. So while we're talking about the dark side, I want to first highlight the problems that annuities create. Liquidity issues. You're locking up money in these products, but you get gain from that. You either get guarantees in performance, or you get no downside risk where the money can't drop below 0%. Uh, but in order to get that, in order to buy that ability, you are locking up money and you will have liquidity issues. There's underperformance. We've seen that a lot over the last few years with these volatility controlled indexes, but also just with the way they're designed with cap and par rates. They're never going to perform as well as the true index, but you're taking away the downside risk. They're on a lot of these products we're going to be highlighting today, fees associated, and of course, sold, not solved, and wrong product chosen. So when we're talking about bonus products, we're talking about the fixed index annuities. These are annuities that have that 0% floor, but upside potential based off of a correlated index. Now, if we look at the historical performance of fixed index annuities, we're looking at about 6.88% annual return. Now, there's a caveat to this because that is the entire industry of fixed index annuities. And if you've been in this industry longer than a week, you know that there are carriers out there with terrible renewal rate history and integrity that kneecap the performance of their products after a few years. You know that there are volatility control indexes that have historically underperformed and performing over the last 10 years between 0 and 2%. And you know that there's people who like to blend in the fixed account, which will perform around 3 to 4% right now. So that is an industry average. Are there products that are going to be performing a lot better? Yes, in our experience with our book of business and equity-based indexes, we're seeing north of 7.5%. But when you're looking at this as a comparison to other products that you can get out there, you're looking at bonds. This is going to be around that bond alternative. It's going to outperform historically what bonds have done without the downside risk. You know, a couple of years ago, we saw a 30% downturn in bond prices. This you're never going to receive that. You're going to have a 0% floor. Now, people like to compare it to the S&P 500 because a lot of them put money into that. But the S&P 500 has outperformed this at 10.44%. Obviously, you have a massive downside risk. We and there are times that it can outperform the S&P in the right sequence of returns and in a high cap product, but that's not something we promise. But as a reminder, we're going to go back to this old slide. This is how these products are credited, that money. So let's say you have $100,000 in the S&P 500, and we're going to look at a real 2-year sequence of returns where it dropped by almost 20% and rose by almost 27%. And in a standard S&P 500 ETF, over those 2 years, you'd get a 2% return. In a fixed index annuity or FIA with a 10.5% cap, you would have received 10.5% in those 2 years. And with something with a 60% participation rate, you would participate in 60% of that gain in year two, and you would have a 16% return over that 2 year period. So when we're talking about bonuses, we're talking about three different types of bonuses. We're talking about premium bonuses, income or death benefit bonuses, and those are couched into separate account bonuses, and crediting bonuses. So let's look at a standard income annuity. So in a standard income annuity, you're going to have your account value and you're going to have your income value. And those are two separate accounts. We're not looking at surrender charges here. We'll get into that later. And based on the performance of the index, you're going to have a max cap of 5% return that you'll receive. And so you see on that account value, the money that you can actually pull out by surrendering this policy is slowly growing at a non-guaranteed rate. In the income column, this is how they build guaranteed income. There is a guaranteed growth rate that's called your roll-up, and then there's a payout factor that we don't have here. And it's that payout factor multiplied by the income value that gets you that guaranteed income. At a certain point, that guarantee stops, and that stabilizes, and until the account value exceeds that, you're not going to get any more income. Now, in these products, you typically don't have a death benefit roll-up. You don't have a separate death benefit account. It's going to be the same thing as the account value, but we have it highlighted here because we're going to touch on death benefit in a little bit. So let's talk about a premium bonus. This is a 14% bonus, and you see it in the account value, you see it in the income value, and you see it in the death benefit. So this isn't a real product. We just added on that 14% onto it. But in this case that you have a premium bonus, it will hit every single account equally. And that will affect the income roll-up, that will affect the index crediting and the death benefit that you receive at the end of the day. But if we have a income-based bonus, it is only hitting the account value. You're going to see a lot higher bonuses from income bonuses because you never have access to that money. It's just part of their math problem in trying to guarantee more money coming out. The only way you will receive that money is from taking income. So if you see these products that have 30% bonuses and you think this is a great way to guarantee return for your clients, a lot of those are going to be in the income space, and you're never going to receive it. And the only reason you should put somebody into a product like that is because you know at some point they are going to take income out of it. Now we have the crediting. You don't see this in the account side. You typically see this on the income value side, and it usually comes along with a bonus as well. So in this case, you get a 45% bonus, and then you get a crediting bonus of 1.5 times whatever your account value is credited by. And that's a much bigger bonus, and you can see here the roll-up never ends, but that's because you're not paying for any guarantees here. These are designed for non-guaranteed income plays where you can have a much higher income value over a longer time if you trust in the market, or you can have better increasing income over time if you trust in the market. This isn't a play for guaranteed income, but as you can see, that it's not affecting that death benefit. And actually, I have a error in my coding there, but you understand the picture here. The death benefit would equal the account value. And then we have death benefit bonuses, and these are typically going to work like those crediting bonuses because these death benefits typically aren't going to be guaranteed if you're getting this. They're going to be these crediting bonuses. There are some that are guaranteed roll-ups as well, but a lot of them are going to be in that crediting bonus, and so you'll have a front-end bonus and the crediting bonus there as well. So now we haven't talked about fees at all and how the performance of these affect end performance in your account value. So we're going to go into that next. So we're only going to be now talking about premium bonuses and accumulation plays. So let's look at the top bonus in the market right now, 22% with a 0.95% fee and a 5.75 cap. Best case scenario, we have a bull run for the next 10 years. you're doing great. You're sitting on 9.4% gain. But because of that fee, you're keeping only about a quarter of that $22,000 bonus that you got in a $100,000 premium. Over the last 10 years, you would be doing worse than the average at 6.4%. You'd keep 8,400 of that bonus, but you're near the average of an FIA performance. And the only time you're sitting pretty, really, you're sitting pretty in the max. You're sitting pretty in this minimum. It's a good situation for these bonuses. And we have, I'm talking about the downsides, but we have advisors who love selling these because they like talking about this situation. If everything goes haywire and we have no growth over the next 10 years, at least I can guarantee you 1% growth year over year. And in this minimum situation. And if the market does well, you're not going to do as well as the average, but you're still going to perform close to it. And that's fine as long as the clients know that going in and that's what they want. Now let's look at a 14% bonus, but this is no fee and a 5% cap. So we're actually doing worse here than in that most recent 10-year period, despite not having a fee, but because of that lower bonus and lower cap. So let's look at one that has even lower bonus at 10%. And because of that, because they're not guaranteeing you as much in the front end, they're able to buy up better options to give you a higher cap of 6.75%. And now we're doing better than the average FIA. We're doing better than both those bonus products that we looked at in the last 10-year period. And even in the minimum category, we're doing pretty well. There's a 1% gain there. Now, if we look at a no bonus, we're just doing an accumulation play. Although that last one looked great, that you're doing better than the average, we're looking at 10.25% cap. And this thing smokes over the last 10-year period and over the max period. Now, of course, it's not going to perform as well on the minimum because we're not getting any guarantees up front. But we also know from the history of the S&P that that's a very, very unlikely situation. Of course, I can't guarantee anything, but if we're looking at a carrier with a high cap, with no frills, no fees, and good renewal rate integrity, we're looking at smoking the average and smoking every bonus product there is. But there's a reason for these products, and we'll get into that in just a second. But 10 years is still a long time to lock up these. And that's the other downside of these is those massive bonuses are going to be on 10 to 14-year surrender charges. We're just looking at 10-year right now in these comparisons because you're not going to see a lot of 14-year surrender periods on anything without a bonus. But let's look at a 7-year because I think that's a more reasonable time to put money into a product with that limited liquidity. And even in this case, you're getting 9.25, and you're going to smoke the bonus products in this situation as well. You get 7.95% over the last 7 years. And we're looking at an end surrender value equal to that of year 7, 8 for a lot of these bonus products. Or sorry, 8, 9 for a lot of these bonus products. And so you're getting that in year 7. And now you can roll over into a new product. So why would you sell this? Well, these are going to be getting you out of bad performing products. The unfortunate part is a lot of those products that these are going to be getting out of are also bonuses. And I'll highlight that for you in just a second here. This is a real policy that we were looking at getting a client out of. They've been in it since 2016, and they've seen about 2% annual gain on this over the last 10 years. They've made $24,000, and they got out of that 24, 8,828 of that is from the bonus. So it's a vastly underperforming product. So now we want to look at taking them out. Well, this is a 14-year surrender charge period, and we're looking at losing 17,000 of that gain. So you're only getting 7,000 a gain if you surrender that policy now. 12.7% loss. How could that be? That's insane surrender charges. Well, it's because this is built with a market value adjustment, and interest rates have gone up, so the price of those bonds that this initially purchased day one have dropped significantly. So you're going to pay $9,456 in a market value adjustment. Then there's going to be a recapture of the premium bonus. This is true on all these bonus products, that there is going to be a recapture, and they're going to recapture 40% of that. And then there's going to be a 4% surrender charge tacked on as well. And now you get to that $7,000 in gain. It just ate all the gain out, and now you have to stick in for another 4 years of likely 2%. But we're looking at another policy of getting them out that is a little bit more reasonable in the market value adjustment. But when you are looking at moving these out, most states are going to require a bonus product to get out and say, I can guarantee that we will make you whole when you enter into this product of all the money you lost back there. So we were looking at a product that we needed to exceed 10% on. And so we looked at these three products. One of them was exactly at 10%. And the other two were at a higher rate. And you can see here at the bottom of the illustrated value, again, this is not guaranteed. We're looking at 459,000, 397,000, and 409,000 for these different products. And you can see that first one that was the best performing was that 10%. It's the lowest premium bonus on any of these, but it buys up the best caps, and it has a 2-year cap here that increases that performance. And you go back on this, the 11% is that second place one, and 14% is third place. The ones that are guaranteeing more front end are doing worse 10 years down the line. But if these fees and charges of market value adjustment and surrender charge exceed that 10%, this is the only product you can use to get out of them. And it's fairly good performing, and you can diversify into the NASDAQ as well instead of just S&P. So are there reasons to use these products? Absolutely. You need to get somebody out of a bad product. You have somebody who is planning on taking income, or somebody who needs a death benefit because they can't qualify for life insurance. There are reasons to use these bonus products. Or if you have conservative clients who are saying, I want a backstop in case there's 0% returns over the next 10 years. There are reasons, but we are also getting a lot of pushback right now from people who are looking at their clients' annuities on the books that were sold by another agent or even themselves at an earlier date that just are underperforming what the rest of the annuity market is doing. And it's our responsibility here to be good stewards of your client relationships. You have invited us in to advise on the design of these products, and so I need to front load a lot of the downsides that come with these. So that's your 20 minutes. I'm about to post a poll. Give me a second because it's the first time I'm doing it, and it's going to be what is our topic for next week. And then also, if there's any questions, I'm happy to dive in as well. Let's see if I can figure out this poll. Watch that. All right. I see one question here. Was Solutions are using the S&P index. Which companies use straight S&P as opposed to various offshoots typically don't perform as well? That's a good question. Most of the carriers we suggest all have straight S&Ps. Now they are going to have a cap on that or a participation rate. It's never going to be Pure S&P can will perform exactly the same. Um, it's going to be capped at, that 10.5%. You're going to have a 60% participation rate. Um, we don't like using a lot of the volatility controls, and carriers that only have volatility controls, I don't trust. There's too much that they can do there in the background to affect your end return. Um, and in terms of have the caps as high as I've illustrated, the 9.25, there's three or so carriers that can do that. The 10 and a quarter, it's one carrier that just has a very clean uh, uh, product that has no frills to it, and they only do accumulation plays. So they're able to offer a lot better um, options there, and they have a lot of money to throw behind it. There are some, I will give the caveat, some carriers that do the S&P futures, and we can do an episode on that in the future and show how closely tied they are together. Good question. Thanks. Let's see. We're tied right now of client profiles that have a benefit from an annuity and how to pick good income annuity. Let's see if we get a few more in here. And Bart as well. I know I didn't highlight who those carriers were. Unless we are doing a presentation where only a single product works for that strategy, we'll try and stay carrier agnostic. But I'll shoot you a call after this, and we can go through what those products look like. Awesome. All right, next week we looks like we're going to be talking about how to pick a good income annuity. Thank you all. This has been your 20 minutes, and I'll see you next week.